Wells Fargo came on the program yesterday. This is what they had to say. No growth this year, negative volume growth next year. How do you value a company if they're going to be the growth figures over the next 2 years?
Yeah, look, I disagree with next year in terms of the negative volume. I mean, like, my view on Tesla is it's easy right now to get negative. Look, they are going, I mean, we talk about it day after earnings here. They're going through a white knuckle period. I mean, China demand's been soft, the margin story, the communication. But look, my view is on the other side of this will be a company on its way 2.5, 3 million units when we look at the next few years. They will gain more share. The leverage will be there. And I believe ultimately numbers, EPS growth will start to come back up.
It just doesn't feel like that's where the market is right now. It feels like the market is in a space which benefits hybrids. Toyota, GM starting to lean in that direction. Think about it. Ford's already there. Tesla just doesn't feel like it's in the sweet spot. What's going to change your mind on this?
I think the issue is, do you want an EV or do you want a Tesla or do you want a hybrid? And I think for Tesla, look, a lot of it comes down to price. And obviously they've cut price. That's what they need to do in terms strategically. The problem now, and speaking to Wells and some others, is that numbers are coming down. It's going to be a sluggish 1Q. So in the near term, it is easy to be negative on this. I mean, our view is, look, we've been here before. The last decade, many times we've been in these white knuckle periods. To me, this is not the end of the growth story. I believe this is a growth story with AI, FSD, that's still going to have a significant piece on the horizon. But no doubt, in the near term, like when I have a positive note on Tesla, probably 30 emails within 10 minutes negative, because sentiment, I mean, look, the Uber driver today was super negative on Tesla.
Yeah, but Dan, you know why they're upset. Because if I'm a client, this stock is down by something like 30% year to date, and you've had a buy on it the whole way down.
No doubt. But
that's why they're upset.
100%. But in my career, in 25 years, our calls have been when things got the worst, whether it was Apple, Tesla, Amazon, Apple. When things got the worst, you handheld through those periods in terms of onto the other side. It is easy to yell fire in a crowded theater when you're going through this period.
Tesla has just been described as a growth company with no growth, and this is coming from a seasoned financial expert. Tesla is a name conjuring up images of sleek electric cars, futuristic factories, and of course Elon Musk. But there's been a rumble in the stock market, and it's got people wondering, is Tesla a high-flying stock growth company, or has it hit a speed bump?
Time now for call of the day. Tesla. It's a growth company with no growth. That's according to Wells Fargo analyst Colin Langan. He's downgrading the stock today from equal weight to underweight. But on the flip side, Wedbush's Dan Ives, a staunch defender, he says the negative noise on the street is overblown. Let's bring in our senior autos reporter, Pras Subramanian, for more. Colin has been tepid on the stock for quite some time, but tepid is not underweight, right? And so it's pretty dramatic here that he's downgrading the stock.
Yeah, I think that headline sort of says it all. The growth, company with no growth. It's kind of highlighting the concern on Wall Street we've seen recently for Tesla. He's warning in particular that cutting prices to boost sales isn't working, noting that sales were only up 3% in the back half of 2023, whereas prices were cut by 5%. So he's kind of concerned there. Tesla itself warned about their growth prospects, saying that they see significant sort of deceleration there. Most analysts think it'll be around 20% for this year. We'll see, maybe less, but we've seen this story before, right? Where the bears sort of got going here in Tesla, and then they were burned. We'll see if Musk can kind of pull a rabbit out of a hat here. But like long term, I think you mentioned Dan Ives. I think people like Dan Ives, even Adam Jonas at Morgan Stanley, say that this is more of a long term play. Look to 2025, even 2026 for a return of that growth. The question is, how long can investors last here when the Mag 7 stocks or the rest of them are kind of taking off, or at least doing better than Tesla?
Yeah. Bloomberg pointed out, by the way, shares of bullish ratings on this name now back to the lows we haven't seen since April 2021. So it's pretty impressive, just the sentiment on the name. It wasn't all bad news, though, right, Braz? There was actually some good news for Tesla today out of Berlin, I think.
Right, restarting that production there. I mean, look, it was bad news when it stopped because of that sort of protest and potential vandalism of like a power substation nearby. But good news that they're back to sort of, I think, not sure if they're at full capacity again, but it takes a while to ramp up. But they were making around 4,000 to 6,000 Model Ys a week there, so that's a significant amount of
I mean,
cars.
that feels less like good news and more like the removal of bad news.
Yeah,
you know what I mean? Less like a forward, sort of pushing development forward. One other headline that caught our eye today is that market cap-wise, Tesla's now fallen below JP Morgan in terms of its market cap. So to your point about the analyst coverage going down, and to your point about sort of trying to time these things, which is notoriously difficult. But it is interesting that we seem to have reached this nadir of sentiment around Tesla, but maybe it could get worse. I don't know.
Yeah, I mean, look, the stock is still sort of richly valued compared to other automakers, but again, you're betting on that long-term growth. You're betting on that sort of they don't have the legacy costs of a lot of these other automakers to go full EV. But the question now is, we saw Adam Jones again with the note today talking about how it's bigger companies that are actually kind of dialing back their EV sort of game plan, dialing back their capital spending, being more sort of thoughtful about that spending, and he upgraded the entire sector. So there's this. What are you looking for now? You want more near-term growth or long-term growth? I think that's the bet right now.
That's a good question.
Tesla's story has always been about growth, disrupting the auto industry, pushing boundaries of EVs and becoming a clean energy leader. They were ambitious goals that fueled Tesla's rocket-like rise. And for a while, that rocket was on fire. Deliveries soared and factories popped up, and the stock price went on a joyride. However, recently there's been a shift in the conversation, as many analysts expect little or no growth from Tesla in the long run, and short term too. In fact, American bank Wells Fargo just described the automaker as a growth company with no growth, adding that Tesla may experience its worst growth story in 2025. But should investors be worried about this prediction, and what should the focus be on right now for investors?
I'd love to hear about some of the names that you're talking about today. I got to talk about Tesla, the worst performer in the S&P 500 this year, or among the worst performers, down 35%. And I'd love to hear your insight. I know you have talked, I guess, with Elon Musk at some point. It was a name that you liked. He's certainly smart and a visionary, but the questions are, is he distracted? Is AI going somewhere other than Tesla? And that was part of the value of Tesla, was the AI story, and is he going to separate that? We saw the launch. I saw the launch yesterday on the rocket, or maybe it was the day before. I mean, that was exciting. What's the big picture on Tesla? It's at 163 today.
Yeah, I mean, I think the big picture, which you kind of summed up pretty well, is that, a lot of things I've been saying over the last 6-7 months have finally come to fruition. I've been warning investors in Tesla for a long time about the fact that Elon Musk's lack of focus and his political stances in support of white supremacy and other very, very controversial, if not just basically wrong ideas, is really turned off a core demo of consumers for Tesla and has hurt demand here in the United States. On top of, incredible levels of competition in China, and now the German, eco-terrorist issue that Tesla's facing with the shutdown of the Berlin factory and enormous cost to get it up again, this quarter is not looking great for Tesla. Meanwhile, the CEO continues to spend a majority of his time on X discussing issues that nobody at Tesla really wants to discuss. So, it's created a reevaluation. We look at the story differently now. It's not the same Tesla story as 3 years ago or 2 years ago. The way we look at it now is Tesla needs to come down to a valuation that makes sense for a company that's not growing earnings, that has issues, but yet still has this amazing long-term potential if there was some focus on building this brand, like advertising to start. So we think, 40 times this year's earnings is a fair multiple for Tesla. That brings you down to 120, and that's unfortunate. So, I hope that doesn't happen, being a Tesla shareholder, but we've pared our position dramatically at our firm over the last 6 months, and I'm grateful I've done that because we reinvested those proceeds into AI investments that have paid off dramatically, and our clients have benefited greatly from this change.
120.
I'm not saying.
Why don't you sell it?
I'm just saying that.
Yeah, are you selling everything?
40 times $3 of earnings. Yeah, 40 times $3 is 120. Explain to me why it deserves a higher multiple than NVIDIA, Microsoft. It just doesn't deserve a higher multiple than NVIDIA and Microsoft. And that's just where I'm at.
All right.
Now, if you're going to tell me earnings are going to go much higher in 2025, 5. Right now, they're $4 earnings. People are already lowering those estimates for 2025 now. Some people are down in the 3s again. So even if you do 40 times 2025 earnings, you're at 160. So there's not a lot of impetus here to say that the stock should be worth substantially more than where it's trading. And that's, I think, the problem with Tesla.
Recently, Wells Fargo downgraded its rating of Tesla from neutral to underweight and slashed prices of the stock from $200 a share to $125. The bank's analysts further pointed out to a growing number of challenges facing the EV maker and warned that the EV demand is still yet to slow down in 2024, and it will continue to do so through the year. This means that Tesla will have to choose whether to continue slashing prices on its vehicles in a bid to maintain competitive edges or save its profit margins by maintaining prices and improving its offerings. Hey guys, welcome back to Tesla Tomorrow. Following the recent price plunge in Tesla's stock price, several analysts are pointing to slowing sales, increased competition in the EV space, and even price cuts, with many suggesting a struggle by Tesla to maintain momentum. According to Wells Fargo analyst Colin Langan, there'll be zero growth in sales volume for Tesla this year, and then it will be worse next year as Tesla volumes will drop significantly. Now, this is a huge prediction, considering the fact that Tesla is one company that many investors love. Plus, judging by all the hurdles that Tesla's come to overcome, shouldn't we expect a much bigger growth in the future? Join us as we investigate all these answers and get some critical answers to these crucial questions. But before we do, if you like this type of content, hit that like button, subscribe, and turn on post notifications to keep up to date on everything going on with Tesla. Not everyone's hitting the brakes on Tesla. In fact, true believers argue that this is just a temporary dip. They point to Tesla's upcoming Cybertruck launch and the company's dominance in battery tech as game changers. And for them, Tesla is still in the fast lane, just waiting to hit the nitro and zoom past the competition. It remains a fact that Tesla has retained its position as a top car seller in the EV market, and it stands at the forefront of the growing electric vehicle and renewable energy markets. It positions itself for immense growth, making it an attractive investing opportunity.
This Model 2 that they expect to bring out in 2025, is it going to be a game changer, or is it too little too late here?
Well, I think that was the other part of our report today. We were looking at the potential for Model 2. And one of the things that really is concerning to me is that it's different from other launches. This is a mass market priced SUV. That's going to be very tough to do. The actual, if you go to an internal combustion engine, compact vehicle today, they're not very profitable. You add on an e-powertrain, you're probably starting off at a losing point. And then if you're then really betting on this unboxed production, which is the new manufacturing methodology they plan on launching with the Model 2. That's a bit of a wild card. It's just never been done before, and we still estimate you need most of those benefits to come through to get this to profit levels that we're seeing on their current vehicles.
What does unboxed production mean? I noted it in your note, and I wasn't sure what it meant.
Yeah, it is a new term. No one has actually done it before. So the idea is it's a change in the entire assembly line. And from experts that we talk to, they're trying to eliminate all the bottlenecks, automate as much as possible. The vehicle won't run through one line. It'll actually be assembled in different subcomponents and then come together at the end. This enables, one of the potential benefits maybe is you could put more throughput through the paint shop, which is the bottleneck today. But also you probably could automate more along the line and eliminate some of the manual inputs. So it's supposed to improve your efficiency. What we found in our report is that there's probably between labor and fixed costs that are absorbed per the vehicle, it's probably $9,000 to $10,000 per car. So if you could double that, there's like $4,000 to $5,000 in benefit. You really kind of need most of that benefit to get Model 2 to probably profitability given the powertrain costs you'll be adding.
What investors need to know is that Tesla's impressive car deliveries, revenue growth, and future plans like the new Gigafactory in Mexico and the Cybertruck release all contribute to its positive outlook. And while the EV market is beaming with heightened competition that could affect Tesla's market share and profitability, we know that it will take a while before anyone attains this level of progress that Tesla has made in the EV sector. Already, Tesla plans to build a new Gigafactory in Mexico and produce 20 million EVs per year by 2030. And while this may seem like a big deal, there are a few reasons as to why Tesla is likely to make this happen. First up, its impressive R&D and execution, as well as expected growth in the EV market. Also, Tesla's innovation and its approach, as well as Elon Musk's reputation as a visionary leader, all set the company apart in the industry, driving its continued success. And as the EV sector continues to expand, the automaker is poised to reap substantial benefits from this growth. Tesla has consistently delivered innovations and efficiently navigated chip shortages by substituting chips and rewriting firmware, enabling better production management compared to other manufacturers. So what's the verdict? Are the bears right? Well, the truth, as always, is probably somewhere in between. Tesla's future growth is not guaranteed, and it faces competition, and keeping that innovation going isn't easy. However, the automaker has also made history by defying expectations, and with Elon Musk at the helm, you never know what crazy ideas he's going to come up with next. And bear in mind that growth is rarely a smooth ride. Even the fastest Teslas hit bumps in the road. So whether Tesla can navigate those challenges and reignite its growth engine is the question that will keep investors and fans glued to their screens.
And we have a special guest here joining us for the entire hour, Sarat Sethi. He's managing partner at TSLA and a CNBC contributor. Good to have you with us.
Good to be here.
It's been a pretty good start to the year.
It has. It has. And what's nice is to see the rally broadening. So it's not just the Magnificent Seven or the less than Magnificent Seven, maybe five. No, I think what you're seeing is at least the breadth of the market improving. And you're seeing other areas of the market actually attracting capital, not just the bond market as well with rates where they are. So whether it's in commodities, healthcare, financials, industrials, I think you're seeing some of those sectors that have lagged actually see capital flowing in there, and companies actually doing pretty well. So I think that combination, along with the overhang now of how long are rates going to be where they are. So
well, we talked about the Magnificent Seven becoming the Magnificent Five. Let's bear down on that. We begin with two widely held names that are both having a bit of a rougher start to the year, Apple and Tesla. And here to help us dig a little deeper in what's going wrong for these two heavyweights is Tony Sacconaghi, Senior IT and Hardware Analyst. Tony, welcome. Good to have you with us.
Good afternoon, Tyler.
Why don't we start with Tesla? What's going on there?
The company entered the year with a very rich valuation multiple, and it's in a period where it may not grow much. Last year, earnings were down. This year, earnings will very likely be down. And the automobile business this year may not even grow. And unfortunately, 2025 is likely to be the same. So you have a stock that's trading at, depending on where you think numbers are this year, somewhere around 60 times earnings, and there's no growth. And you were talking about how there have been shifts in the Magnificent Seven. I think, part of the challenge for Tesla and to a certain degree for Apple and why you're seeing investors vote with their feet is neither are growing this year. And it's tough paying up for companies that aren't growing. So there's clearly, concern for Tesla in the near to medium term about its ability.
Tesla also has increased liquidity and institutional support. Its shares have become more liquid and available at a lower price with a strong backing from institutional investors. In a previous note from Morgan Stanley, the firm noted that Tesla will soon expect a reset year, especially as EV supply is expected to exceed demand. The firm believes that Tesla can thrive in the competitive EV market, and that's because players who are self-funded and demonstrated scale and relatively low cost throughout the supply chain like Tesla can be relative winners in the EV space. From an investor perspective, Tesla's got a lot of opportunities for growth, and let's remember that increased EV sales and record-breaking deliveries can have a significant impact on stock performance. Positive delivery numbers instill confidence in investors, reinforcing the belief that Tesla is not only a leader in the EV market, but a force to be reckoned with overall in the auto industry. The surge in deliveries also indicates that Tesla's products are resonating with consumers worldwide, and it's solidified Tesla's position as a dominant player in the market and demonstrated its own ability to capture market share from traditional automakers. We believe that Tesla is well positioned to experience significant growth this year, even though its stock has been pretty volatile. In fact, there's a huge chance of seeing Tesla make a 10-time stock price rally in the near future. No doubt in reality, things don't always work out as planned, but it's good to remain optimistic about Tesla.
Ability to grow. They seem to have put a lot of emphasis on lower priced automobiles, including a new model that I think is coming out next year, the Model 2, if I have it correctly. Do you think going down in price is a long-term win for this company or not?
Tesla absolutely has to make its cars more affordable if it wants to become an industry-leading car company. Right now, Tesla's models are largely at $40,000 and above, and that's a relatively narrow market. So Tesla's aspirations and its valuation suggests that it's going to be a dominant car company, potentially as big as, Toyota or Volkswagen, who are the biggest car companies in the world today. But in order to do that, you have to appeal to a broader set of consumers rather than, relatively affluent consumers. So it absolutely has to go down market. And the challenge is it's going to take some time. The car will likely only debut at the end of 25. It'll take some time to ramp that car. So Tesla may not see, real volume benefit from that car till late 26 or even 2027. And that's a long time for investors to wait.
Is that why BYD, though, is outpacing Tesla right now, that they have more models to choose from for lots of different consumers?
Absolutely. I mean, Tesla really has 4 models and 2 of them are above $70,000. BYD has almost 30 models and they start in China with micro EVs at under $10,000. So they're certainly able to, and they largely play in the Chinese market, offer a full suite of products from low end to more expensive ones. They just introduced a luxury car that's over $150,000. So they are providing enough choice to offer the entire marketplace, which Tesla is not. It's really playing in the luxury niche market at this point.
And while we shine the spotlight on Tesla's challenges, let's take a victory lap to celebrate the areas where Tesla is leaving the competition in the dust. First up is batteries. Tesla's battery tech is the secret sauce, and it's got a pretty good hold on the battery game, and it's done so for a long time, and it's quite evident. The range and efficiency of Teslas are tough to beat, and it translates to happy customers who can make more road trips on a single charge. Next up, supercharger. Tesla's basically built its own gas station network, one that's way cooler and emissions-free. These high-speed charging stations are popping up all over the place, making long-distance travel in Teslas a much less stressful affair. Sure, other companies are building charging networks too, but Tesla's had a head start and a loyal following of drivers who wouldn't dream of plunging into anything else. And of course, we can't ignore the innovation factor. Tesla has a knack for thinking outside the box. Its Model S particularly started the whole electric car movement, and the Cybertruck is a whole different kind of beast. Love it or hate it, you can't deny that this Cybertruck is actually a pretty big, bold puncher when it comes to pushing the boundaries of what a truck can be. This kind of out-of-the-box thinking keeps Tesla exciting and unpredictable, and it's a major win in the car market, which can get a little snoozeworthy at times. And then there's Elon Musk, the passionate leader who can't be underestimated. He's like a powerful force keeping Tesla afloat. So while it is obvious that Tesla might be facing some challenges, it's far from down and out. And with the automaker's tech and charging network, innovative spirit and charismatic leader at the wheel, Tesla is still well positioned to leave its mark on the industry. This is a company that has encountered production challenges, but we're hopeful that it will overcome them, as any ability to meet product demand is vastly needed, and any inability to do so could negatively affect the automaker's revenue and profitability and raise concerns for potential investors. What do you think? Is Tesla really a growth company with no growth? Let us know your thoughts, and don't forget to let us know what your valuation of Tesla is. And for more updates on Tesla, go ahead and click on this next video on your screen. See you there.